Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today I would like to discuss with you about double entry bookkeeping system. In the previous sessions, we discussed about accounting concepts and conventions, various types of accounts, and in this session I would like to discuss with you about the concept of double entry bookkeeping system and how to differentiate single entry system and double entry system, types of accounting process. So let us start with bookkeeping, accounting and accountancy. Bookkeeping is a part of accounting and it is the process of identifying, measuring, recording and classifying the financial transactions. So in business organization every day the businessman they used to record the daily transactions in the books, which are known as books of accounts. Based on those daily transactions, they used to prepare final accounts at the end of every financial year. So, with the help of those financial statements, they used to evaluate the financial performance of a business entity. Coming to accounting, it is a wider concept and actually it begins where the bookkeeping ends. It includes summarizing, interpreting, and communicating the financial data to the users of financial statements. And accountancy means systematic knowledge of the principles and the techniques which are applied in accounting. So, whenever they are going to record the financial transactions, they have to follow the universally accepted principles, and that process is known as accountancy. Then let us discuss bookkeeping system. Bookkeeping is the process of recording a company's financial transactions into organized accounts on a daily basis. It can also refer to the different recording techniques business can use. So, bookkeeping is an essential part of the accounting process for a few reasons. The first one is to keep transaction records updated, and second, to generate accurate financial reports that helps to measure the business performance. So, for that reason, every organization they used to maintain the books of accounts. There are following two systems of recording transactions in the books of accounts. One is double entry system, second one is single entry system. Double entry system means which is based on the dual aspect principle. So every transaction has two aspects. One is a debit, another one is a credit of an equal amount. So this system of accounting recognizes and records both aspects of the transaction. For example, Mr. A invested 50,000 in the business. So this is the transaction, whatever recorded in the primary entry. So the same account, see he invested means it is in the form of capital and he invested 50,000 means in the form of cash. So we used to specify this account in two ways. One is in terms of the capital, another one is in terms of cash. So this type of recording the transaction of the same equal amount in two different accounts is known as double entry system. Single entry system means both aspects are not recorded for all the transactions. Either only one aspect is recorded or both aspects are not recorded for all the transactions. So that is known as single entry system. Instead of recording both transactions either in capital or cash, so people they may specify in terms of capital account or in terms of cash. So that type of system is known as single entry system. Only once we are going to record the transaction in the books of account. So single entry bookkeeping means it is a straightforward method where only one entry is made for each transaction in the books of accounts. These transactions are usually maintained in a cash book to track incoming revenue and outgoing expenses. For example, if you're talking about a cash book, so in the cash book, the transactions related to revenue and expenditure is going to mention. So just what comes in and what goes out. So that we are going to mention only one transaction in the book of account. So that type of system is known as single entry bookkeeping. These transactions are usually maintained in a cash book to track incoming revenue and outgoing expenses. So no need of formal accounting training for the single entry system. Anybody can enter these transactions. For that, there is no special training is necessary to record in or to adapt single entry system. The single entry method will suit small private companies and sole proprietorships that do not buy or sell on credit, own little to no physical assets, and hold small amounts of inventory. As they used to maintain only small amounts of inventory, so even the transactions that should be done on the basis of cash. So that is the reason they will go with single entry method. Then coming to the double entry bookkeeping. Double entry bookkeeping is more robust. It follows the principle that every transaction affects at least two accounts and they are recorded as debits and credits. For example, if you make a sale of 10 rupees, your cash account will be debited for 10 rupees and your sales account will be credited by the same amount. In the double entry system, the total credits must always equal the total debits. When this happens, your books are balanced. So using double entry method for bookkeeping makes more sense if your business is large, public, or buys and sells on credit. So in case of credit related transactions, one should go with the double entry bookkeeping system. Enterprises often choose the double entry system because it leaves less room for error. Because the same transaction we used to enter in two different accounts. So there will not be any kind of chance for errors. In a way, it double checks your accounts because each transaction is recorded as two matching but offsetting accounts. Then coming to the advantages of double entry system, the first advantage is scientific system. As compared to other systems, the system of recording transactions is more scientific and useful to achieve the objective of accounting. A complete record of the transaction. Since both aspects of the transactions are considered, there is a complete recording of each and every transaction. Using these records, we are able to compute profit or loss easily. And third advantage is that checks arithmetical accuracy of accounts. So under this system, by preparing trial balance, we are able to check the arithmetical accuracy of these records. And fourth one is that determination of profit or loss and depiction of financial position. So under double entry bookkeeping system, by preparing profit and loss account, we can able to know about the profit earned or loss incurred. By preparing the balance sheet, the financial position of the business can be ascertained. It means that the position of assets and liabilities is depicted. So in the balance sheet, one can able to see the number of assets and number of liabilities incurred in the business. Next one is helpful in decision making. Administration and management are able to take decisions on the basis of factual information under the double entry system of accounting. Then the difference between bookkeeping and accounting. So the basic parameters that differentiates bookkeeping and accounting are scope. Under bookkeeping, it involves identifying, measuring, recording, and classifying financial transactions in the ledger accounts, whereas in case of accounting, it includes summarizing, interpreting, and communicating the financial data to the users of financial statements. Objective of bookkeeping is to maintain systematic records of financial transactions, whereas the objective of accounting is to ascertain the profitability and financial position of the business. When we'll use bookkeeping means it is a primary stage of accounting, whereas accounting is the second stage. It begins where bookkeeping ends. Coming to the nature of job, under bookkeeping is routine and repetitive in nature, whereas in case of accounting, this job is analytical in nature. Then coming to the levels of skills, bookkeeping does not require any special skills. It is performed by junior staff. Whereas if you want to go with accounting, it requires specialized skill to analyze, so it is performed by senior staff. Then coming to the concept of account debit and credit. So one must get conversant with these terms before embarking to learn actual record keeping based on the rules. An account is defined as a summarized record of transactions related to a person or a thing. For example, when the business deals with customers and suppliers, each of the customers and suppliers will be a separate account. We must know that each one of us is identified as separate account by the bank when we open an account with them. The account is also related to things, both tangible and intangible. For example, if you take land, building, equipment, brand value, trademarks, etc., are some of the things. When a business transaction happens, one has to identify the account that will be affected by it and then apply the rules to decide the accounting treatment. Typically, an account is expressed as a statement in the form of English letter T. It has two sides, left hand side, debit side, and right hand side, credit side. The debit side denoted as DR and credit side denoted by CR. The convention is to write the debit or credit labels on both sides as shown below. Each side of the account will show effects so that one can easily take totals of both sides and find out the difference between the two. Such difference in the two sides of an account is called balance. The same amount we use to record on both sides of the statement. If the total of debit side is more than the credit side, the balance is called as debit balance. And if the total credit side is more than the debit side, the balance is called credit balance. If the debit and credit are equal, the account will show nil balance. The balances are to be computed at the end of each accounting period, and these balances are then considered for preparation of income statement and balance sheet. Let us see the example debit cash account credit. So if you see this cash account, we have two sides. Left hand side is known as debit and right hand side is denoted as credit. So coming to the particulars, cash brought into business is how much 1 lakh rupees we invested in the business in the form of cash and received for goods sold. So we have generated some revenue just by selling the goods. So that we have mentioned 25,000. Whereas coming to credit side, paid for goods purchased. So as we purchased some goods, we paid some amount in the form of cash, that is 50,000, that is an expenditure, and paid for rent, that is also an expenditure, 15,000, and balance at the end. If you see, debit side balance is 1,25,000, whereas credit side we have only 65,000. So the balance at the end 60,000, so that we can able to balance both sides of the cash account. It can be seen from the above example that the debit side of cash account shows the receipt of cash into the business and the credit side reflects the cash that has gone out of the business. The balance at the end shows that cash balance available in the business. Then coming to the types of accounts, an account may be related to a person or thing, whether it is tangible or intangible. While doing business transactions, one may come across numerous accounts that are affected. If common rules are to be applied to similar type of accounts, there must be a way to classify account on the basis of their common characteristics. So basically we used to divide into two types, personal accounts and impersonal. Whereas personal accounts further divided into three types, natural persons, artificial persons, and representative persons. Whereas impersonal accounts they are further divided into real accounts, nominal accounts. Real accounts further classified into tangible real accounts and intangible real accounts. Each type of account means, for example, if you take example of personal account, as the name suggests, personal accounts means these accounts related to the persons. And the persons could be natural persons like the names of the people, Suresh account, Anil account, Rani's account, etc. The persons could also be artificial persons like companies, bodies, corporate, or association of persons or partnership, etc. So accordingly, we could have Videocon Industries account, Infosys Technologies account, Charitable Trust account, Alliance Sons Trading account, ABC Bank account, etc. And these could be representative personal accounts as well. Although the individual identity of persons related to these is known, the convention is to reflect them as collective accounts. For example, when salary is payable to the employees, we know how much is payable to each of them, but collectively, the account is called as salary payable account. Similar examples are rent payable, insurance prepaid, commission pre-received, etc. And second category is real accounts. There are accounts related to assets or properties or possessions. Depending on their physical existence and otherwise, they are further classified as follows. Tangible real accounts, assets that have physical existence and can be seen and touched. For example, machinery account, stock account, cash account, vehicle account, etc. Whereas coming to intangible real account, these represent possession of properties that have no physical existence but can be measured in terms of money and have value attached to them. For example, goodwill account, trademark account, patents and copyrights account, intellectual property rights account, and the like. And third category is known as nominal account. These accounts are related to expenses or losses and incomes or gains. Example, salary and wages account, rent of rates account, traveling expenses account, commission received account, loss by fire account, etc. There are two types of approaches for deciding when to write on the debit side of an account and when to write on the credit side of an account. So there are two types of accounting processes. One is American approach, which is also known as modern approach. Another one is British approach, which is known as traditional approach or double entry system. Coming to the first one, the American approach. In order to understand the rules of debit and credit, according to this approach, transactions are divided into the following five categories. The first one is transactions relating to owner. Example, capital. So capital account, these are personal accounts because we are specifying the transactions related to a person. So this is a personal account. Transactions relating to other liabilities, for example, suppliers of goods. These are mostly personal accounts. Even suppliers also, they are the persons. And transactions relating to assets, example, land, building, cash, bank, stock in trade, bills, receivables, etc. So these are basically all real accounts. Then fourth category is that transactions relating to expenses. Example, rent account, salary, commission, wages, cottage, and these are all known as nominal accounts. And fifth category is that transactions relating to revenues. Example, interest received, dividend received, sale of goods, these are all nominal accounts. Then coming to the rules of debit and credit in relation to these accounts according to American approach. For example, if you take example of this capital account, so when you are considering capital account, debit means decrease, credit means increase. If you find there is a decrease in capital, that should be mentioned on the debit side of the capital account. And if you find a rise in capital, that should be credited and which can be mentioned on the right side of the capital account. For any liability account, debit means decrease, credit means increase. Whereas for any asset account, debit means increase, credit means decrease. For any expense account, debit means increase, credit means decrease. For any revenue account, debit means decrease, credit means increase. So the meaning of debit and credit has been diagrammatically illustrated as under for assets, increase in assets, then we have to mention on the debit side, decrease in assets, credit side. Whereas for liabilities, decrease in liabilities, debit side, increase in liabilities, credit side. For capital, decrease in capital, debit side, increase in capital, credit side. In case of incomes, decrease in income, debit side, increase in income, credit side. For expense, increase in expense, debit side, decrease in expense, credit side. Then whereas related to stock, increase in stock, debit side, and decrease in stock, credit side. So these are the fundamental rules one should remember when we are going to enter the financial transactions based on the modern approach or American approach. Ascertain the debit and credit from the following particulars under modern approach. Started business with capital. So if you see the effect, increase in cash, increase in capital. So as there is an increase in cash, the account type of account is known as cash account and that should be debited, and increase in capital account, it should be credited. Then bought goods for cash. It means that there is an increase in stock. So the type of account is known as purchase account, and whenever you find increase in stock, and we have to mention on debit side, decrease in cash, and it is related to cash account, then it should be mentioned on credit side. And third, sold goods for cash, increase in cash, as we sold the goods in return, we generated some revenue. So as there is an increase in cash, so then that should be mentioned on debit side in the form of cash account. And as a result, as we sold the goods, there is decrease in stock. So sold goods means sales account. That should be mentioned on credit side. Then paid salary, increase in expense. So it comes under salary account. That should be mentioned in debit. And decrease in cash, cash account, credit. Received interest on investment. Increase in cash as we have invested some more amount in the business. So as a result, there is an increase in cash. So it is cash account and that should be mentioned on debit side. And increase in income. So just interest as you brought from outside in the form of debt. So interest should be payable. So increase in income due to interest. So interest account, credit, and bought goods on credit from Mr. Y. So whenever you bought purchase goods from Y on credit basis, your stock levels increased. So increase in stock, purchase account, debit side, increase in liability, Y account, credit side. Paid rent out of personal cash. So there is an increase in expense. So paid rent means it comes under rent account. Again, it should be mentioned debit side. and increase in capital account, credit side. Then second approach is British approach or double entry system. When one identifies the account that is getting affected by a transaction and type of that account, the next step is to apply the rules to decide whether the accounting treatment is to debit or credit that account. The golden rules will guide us whether the account is to be debited or credited. There is one rule for each basic type of account: personal account, real, and nominal accounts. These rules are shown in the following chart. Personal account, if you take debit the receiver or who owes to business, credit the giver or to whom business owes. Whereas coming to real account, debit what comes into the business, credit what goes out of the business. Coming to nominal account, debit all expenses or losses, credit all incomes or gains. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.